So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. This is 50 Pips, rocking and rolling here. 24th of December 2019. As always, no trade calls, no recommendations. Everybody sponsors for their own stuff because we're here for educational purposes only. So, a little attempt to record an audio update here. I'm not sure if it actually is going to work because I'm not in the office, but I've been thinking about end of year things as one does this time of the year, and I was going through various things on my to-do list. And one of the things which I'd been meaning to do for pretty much the whole year was record a proper video and write a detailed post on things I would keep in mind when analyzing Darwin's. But both these things just keep on getting pushed back, and it just doesn't look like I'm going to have time to really do these things properly. So I wanted to go ahead and just try and talk through a collection of notes that I've been making to myself or thoughts on this topic. Now, as always, there's no right or wrong, and I think for every point I will be making, you could argue the opposite. But again, it's not set in stone. There are a lot of different ways to skin a cat. It's just some food for thought, as I've seen a lot of people make what I think are unnecessary mistakes or trying to approach it in a way that may make things a little bit more difficult than they should be. So if you're a 50 Scouts member and you're really interested in this topic, let me know, send me a note. And if there's enough interest, I will try and set something up in a little bit more detail next year, maybe a dedicated webinar. But again, remember, these are just my thoughts. So essentially, here we go. I mean, first thing I would say is really that if you're looking at a Darwin and trying to analyze a strategy, you really want a native track record, right? And I think for starters, you need at the very least 12 months native. I personally have zero interest for any of the migrated info, so I don't even look at it. I know people will argue you can look at it. I couldn't care less, okay? Another thing I would say is understand how the math works, and don't forget that the biggest drawdown is always in the future, right? And that goes for everybody, right? Your biggest drawdown is yet to come. So don't be fooled by looking some of these strategies and thinking that you can bank on past performance. And also keep in mind the climate we've been here, right? Essentially since 2008, 2009, for the last 10 years, apart some shocks here and there, really volatility have been very subdued. Not an awful lot has been going on. It's been a one-way trade. Most of the currencies have been relatively range bound. Okay, we've had some move and markets just been in a grind higher mode. So as far as I'm concerned, none of these tracks we're seeing here really have been tested at all. And also, we still haven't seen how the actual Darwin performs in some kind of a funky market environment or sustained market environment, right? Another thing is, as always, look at how leverage is being used, right? And not only how it's being used, but how it's being deployed through drawdown periods, right? And this goes both for newer strategies and for ones that have a lot more history. Remember that usually a bad LA and RS score together tends to make for a recipe for a pretty toxic cocktail. So you want to watch out with that. And even if pure trend followers would probably beg to differ with me, I would have zero interest in buying at all-time highs, right? I would really, if you find Darwin's you're interested in, I would be mechanical and give yourself the opportunity to work into a position. Now, that doesn't mean that you can't put out a feeler position or a starter position, But again, don't forget how the math works. Nothing goes up in a straight line. So sooner or later, if you're diligent and you're patient, you're smart about it, you should be able to work yourself a better overall entry. Unless you're completely price agnostic, well, that's just up to you. Now, speaking of this, I really think that the Darwin selection makes a lot more sense for people who are looking for buy and hold, or not necessarily buy and hold, but for longer term positions, right? To me, it makes a lot more sense. I think there is a case to be made for being aggressive and tactical, but in that case, I would say two things, right? Either you're trying to be aggressive and tactical because you're looking at specific Darwins and seeing certain behaviors and you think you can take advantage of that. But then again, if you're good at doing that, I would do that on other asset classes, not at Darwin's, because essentially it's a job on its own, right? You'd have to really spend so much time that essentially that's the only thing you do, right? Or you just have to devote an awful lot of time to them. And second of all, if you're not doing it in terms of specific Darwin behavior, but you're looking at it more from a broader technical perspective on the Darwins, if you're going to trade, there are much better places to trade, on a bigger listed exchange with assets that are more tried and tested, assets that have a better bid-ask spread, and assets that have far more liquidity, right? So as a side note, and I don't want to get in trouble with this, but don't fall into the trap of people who have trouble building a successful track record trading, Forex futures, stocks, whatever, and then they end up trying to trade Darwin's, right? It's still an asset class. So the same principles apply. And if you weren't good at one, you're likely not going to be good at the other one. And if you're going to invest a lot of time and effort, you're more likely to do it on the bigger asset classes and the most tried asset classes. And I would keep the Darwin's just as looking for opportunities to as some kind of portfolio allocation to this asset class and as longer term holds. I think that, again, everybody has a plan until they get punched in the face. And what I see a lot of people looking at some of these returns, thinking that, it's a done deal. They will always be there. Things won't go down anymore. And again, going back to my earlier comment, remember, you have to go through full market cycles, and we haven't really gone through full market cycles. And you're also dealing with individuals that are slowly having AUM, which are not necessarily used to having AUM, and in most cases are not used to trading larger accounts or having bigger responsibility for their actions. And what that means is that you have what we would call, essentially Keyman Risk. You have no idea how these managers will perform once they get allocated money. You don't know what their motives are. You don't know what their incentives are. So I think prudence is always advised, and it's better to go slow and steady and not get carried away, right? From experience, I'm not going to go into detail, but I know a lot of traders, and I've worked with a lot of traders that had extremely good track records for multiple years, and then once they started to get allocations, they just they found it very hard and didn't behave the way they usually behaved, right? And that's something which it's unavoidable, so you want to keep that in mind. And in that on that note, I would also say it clearly makes sense, or to me, to also take a peek at the underlying account and the underlying strategy, right? So even though for some aspects it's maybe misleading, because also the way some people are using the capital in there may mean that basically the P&L curve could be a little bit misleading. I would say remember that what you are buying or what you are thinking of investing in is an asset which is offered by Darwinex, and is managed by Darwinex, right? It is based on the underlying strategy, but do not be fooled. Don't think that you are investing in a manager that is controlling the Darwin you're buying or selling, right? The only thing that the manager really, and we could go on for ages on this, but the only thing the manager controls is the underlying strategy. So keep that in mind. Okay, I know this may be a little bit controversial, but keep that in mind. As far as I'm concerned, also, apart from looking at the underlying strategy, and you're trying to do a little bit of due diligence, and this may seem a little bit anecdotal, but I feel fairly strongly about this, and time will tell, but 9 times out of 10, looking at the strategy name is all you have to do for your due diligence. Or 9 times out of 10, just by looking at the strategy name, the username, and the bio, you should be able to understand who you're dealing with. And buyer beware. If the bio, the name, the strategy name, are kind of Joker central, right? I'm not going to make any comments or anything or say what it could include because then it's going to get me in trouble. And the returns are there. Don't be fooled. Usually, sooner or later, it might take a year or so, it might take 2 years. Things line up, okay? Things line up. So again, buyer beware, do your due diligence. But most of the time, as far as I'm concerned, and I've been looking at these things from the start, 9 times out of 10, just looking at those 3 things, it's good enough. You don't have to dig much deeper. The other thing I would say, and this is a little bit of a pet peeve of mine, but if the provider has made tens of thousands or even 100,000, whatever, euro or dollars in performance fee, but can't even be bothered to top out their account with the 10,000, which is the maximum that Darwinex will show. Personally, I have a lot of problems with that, and I think it tells you a lot about the provider. Again, you could argue he's put a lot of money in his own Darwin, but still, and this could be a session on itself, but think about it psychologically. There are a lot of things going on there, but if they can't even be bothered to show the full 10K investment, if they're raking in much more than that, well, to me, that's a little bit of a red flag, or it shows you what kind of person you're dealing with. The other thing is a lot of people ask me about filtering on the specific attributes. Now, as far as I'm concerned, I've created my own filters, and most people will be shocked that I pretty much don't focus on any of the attributes. I think it's interesting to use the D-score as a baseline filter, but as far as I'm concerned, there are 3 or 4 other things which are far more important. And again, if we do a specific webinar for the 50 Scouts guys, we can go that into a lot more detail, but that's a bit beyond the point of this little chat here. But again, I wouldn't pay too much attention to those attributes, because I think what's more important, right, if you're filtering them, if you want to focus on the attributes, is look at the rate of change, right? Rather than the actual value, right, or what that builds up to a D-score, because that's Darwinex's assumption of what they think a good strategy should be, what they think a reliable strategy should be, or what they think strategies that the algos can understand and replicate is, right? Whereas, certain styles will be severely punished by certain of the specific attributes. So I think it makes a lot more sense to look at the rate of change, or the rate of change with a combination of them, not to look at them individually. As always, you have to have realistic expectations across the board, and it's a process, right? There are a lot of good traders on there, and there are a lot of good strategies, but essentially nothing is going to be a golden goose, right? There's no magical strategies. There's no magical system. Now, because of the VAR, of course, a lot of these strategies are levered up, but, go back and look at what the best investors did So you can think of Druckenmiller, you can look at Buffett, even though I wouldn't use it Buffett, but you can look at Simmons, Druckenmiller in terms of compounding returns over time. Now you can strip those based on the VAR to a more normal leverage that these strategies or these great investors in brackets probably used, which is closer, to probably less than what the VAR is doing. But again, keep in mind, chances are Druck or the next Druck is not on the platform. He might be, but chances are he's not. So keep that in mind when you're looking at returns, and keep in mind, again, the context these returns have been generated in over these past years. And again, zero interest in terms of the migrated data. Zero interest, guys. Wishing you all the best. I hope I can do this. As you heard, I had a phone ring. I'm not in the office. I just had some spare time and I'm trying to record this on my phone. Let's see if I can get everything to work to post it, and if it's useful or it's just a little bit of food for thought for anybody, that will be my good deed done for the day. Wishing everybody all the best for this holiday season. Hit me up if you have any other questions. All the best. Take care. Bye-bye, guys.